Hello, everybody. So today I want to quickly talk about, can we ever catch the bottom? And there are red day markets opportunities, because of course everything's crashing. The Nasdaq, the Dow, really, really red day, bad day in the market today, because as it turns out, nobody wants to buy bonds. Nobody's bidding on bonds, and so the 10-year yield is going up. And I just wanted to do like a general macro video. I know we are very tired of buying the dip. I personally am getting tired of buying the dip. It feels good to see the portfolio in the green and always in the green. It feels good. But it's not good for us. It's actually much better for us to buy when stocks are cheap. There's a difference between the feeling, it feels good, and actually what's good and what's not good. It's true that this bear market is longer than history usually suggests. So we are in a longer bear market than history usually suggests too. But as bad as it feels to see the red every day, we need to realize that if we are in a net accumulation stage, which I think is the case for so many folks, most viewers of the channel are in the accumulation stage in their life. A video a week ago I mentioned that, if you're still accumulating stocks, you may be tired of buying the dip, and the dip keeps on buying, and you keep buying the dip. We've all seen these famous memes online. But the truth is, even viewers in their 60s, as many commented in the comment section, even viewers in their 60s may still be accumulating. So the truth is, the bear market is only problematic if you are a seller. If you are a net seller of a portfolio, that's when it's problematic. And if you would be a net seller of your portfolio, obviously, if you're living on your portfolio. And if I were into that phase, if I were living on my portfolio and not earning income, I would obviously be very annoyed by this dip. But the truth is, for so many people who are not retired yet, this is not the case. This is not the case. And if you are retired, well, maybe it's wise to wait a little bit. Postpone the vacation, postpone the home improvement. But it bears repeating for a large majority of people who are in an accumulation stage of capital, which I think is the case for most viewers of the channel, given the name of the channel, be it the denominator, given the type of stocks I cover. If you are in that category, it's objectively an opportunity, these dips, even though it's getting tired and it feels bad to see red. That's how we are tired. That's how we are wired in our brain. We see red, it feels bad. Bad news really gets us upset, I guess, in a way. And my take on the market, and this is perhaps the core of the video here, is that we live in a single issue stock market right now, just like you have single issue political candidates. And the issue has been the same for a year and a half, which, believe me, this bothers me more than even the stocks dropping or being flat, depending on which stock you look at. What bothers me more is the narrative, is this unsophisticated, pretending narrative of Jay Powell and the rest of the market. That's all it is. Like this narrative is really getting annoying to me. It's about Jay Powell. Jay Powell is bluffing by making everybody believe that he's being a hawk and he's going to keep interest rates this high so that he can tame inflation and stun the economy. Right? That's the narrative. And he does that usually by using very convoluted narratives. But really, when you talk about a softening in unemployment or a softening in different sectors of the economy, he's trying to create an economic crisis. And we all know that. The way to read it into this is, it would be nice if some of you lost your houses, lost your jobs. That way, we would get a little bit of an economic crisis, and we would stop inflation. And the market is not really buying it. It's all economists, in my view, don't really have a good handle on the economy, and they forget that companies are led by entrepreneurs who create value, and it's not a zero-sum game, it's a positive-sum game. Markets do not believe that the interest rates will stay this high. There is just too much debt out there and not enough people to buy this debt. This is why investors are requiring higher and higher yields in order to own bonds. They're bidding up the yields, and that's why the Treasury yield right now, the U.S. 10-year is at 10.78. So it's compared to even 4 months ago. I mean, it's a stark increase. It's up to 50% higher on the 10-year, just simply because there's many more bonds that are being issued, treasury bonds, treasury notes, and few people are bidding on them. Few people are buying them. They require this high level of return. And of course, whenever you have the threat of a government shutdown, the threat of a debt ceiling deadline, that doesn't help making this debt cheap. So there's a general lack of buyer for that debt. And the Fed has been trying to unload its balance sheet, right, to reduce inflation, to remove some of the former money creation that has happened. It's been trying to unload this balance sheet. But, in my view, at this pace, it's going to take a decade to get back to the 2020 level. It's going to take a decade. You see, we're a good year and a half in. And I believe the number is 800 billion. We've dropped the balance sheet. The Fed has dropped the balance sheet by 800 billion. So it may take actually 15 years at this rate, of course, to just get back to the 2020 level. Which is why I believe monetary printing is endless and is never going to stop. And of course, this 8 trillion on the balance sheet, it's important to know. And this is the quote from Jay Powell on 60 Minutes, right? On a 60-minute interview right after mid-March 2020. You may remember what he said, where this money comes from. The anchor says, "Oh, so you just printed it?" And then he said, "Well, we printed it digitally. We printed digitally. We printed digitally." Right? That's what this is. We print digitally. By the way, if you're wondering, the spike, which had almost erased all of the effort, that was the bank term funding program that they did to save many of the regional banks. And if this continues, bigger banks might be in trouble and they might have to have another spike. To me, this is just inevitable. They're not going to be able to sell all of this debt when more people compete against the Fed and issue debt. They're not going to be able to sell off this Fed. This is all of the debt that they own, Look, almost 5 trillion of U.S. treasuries alone. It's insane. 2.5 trillion of mortgage-backed securities. This is the Fed balance sheet. This is all of this money, what it's composed of. I mean, it's a crazy amount of money that they've just created, that they're trying to get out of the system to remove inflation, but it's not working. They can't do it. And you see, they've tried before, barely made a dent. In my view, they will have to resume QE. They will have to resume QE, especially as the USA may need to issue 2 trillion in treasuries next year. 2 trillion in treasuries. There's not going to be enough buyers out there, or if there are, the interest rates are going to be impossible to sustain. You will have systemic, bankruptcies, because if rates go up, obviously the cost of financing for so many companies goes up, and then the number of zombie companies, the number of companies who can't even meet their debt, is just going to go up exponentially. So they can't keep it that high. The supply of bonds in the market is just too large. There's just too many bonds out there compared to the demand for those bonds. There's too many bonds out there. The Fed is the main demand for bonds. They're the main buyer of bonds. At least for as long as I've been investing, they've been the main buyer of bonds. And in my view, they will continue to be the main buyer of bonds. And you have megatrends that also don't help these bonds getting bought. Older generations are retiring, and they're selling their bonds sometimes for their living expenses, or for times because they want to buy Tesla stock. I mean, I'm not joking. Like, this is a real thing. If you follow the Tesla community, there's plenty of Tesla retirees, 75, 80 years old, who own Tesla stock, and who may be all in on Tesla stock. Many of them have podcasts. I don't know if you follow some of them. It's a thing. So they sell their bonds, perhaps not even to just live life. They sell bonds perhaps to buy stocks. A younger generation have never liked bonds too much. They usually don't like bonds very much in younger generation. It makes sense. It's even common thing said by financial advisors, right? But it's even worse now because they actually prefer crypto, and that's where I stand. I think a good alternative of, if you want another asset class, I think Bitcoin is a good alternative. At least for me, Bitcoin is my bond alternative. If Bitcoin didn't exist, I would probably be all in stocks, but now they have an alternative for bonds, in my view. And the internet, is important to note. The internet has made information largely free, or flat, as I like to call it. Information is like flat. So what you find is that a lot of people today, they do their research on their retirement account. They do the research. Many people are questioning the target retirement fund that you're put automatically at your workplace, and you have a target life cycle fund, retire in 2065 or 2060. And these funds have crazy amount of bonds, and people are catching up on that and moving away from this, and largely actually buying the S&P 500. I happen to believe the Nasdaq is for my retirement I'm 100% Nasdaq in my retirement. But a lot of people like the S&P 500 or the total stock, and they go ahead and they just buy the total stock, investing, and you have a bunch of books. It's almost a societal trend of people who are doing everything they can. If you've heard of the FIRE movement, they're doing everything they can to buy index funds, typically S&P 500, and live off of their index funds with a 4% rule, and boom, no bonds. Bonds are just not very popular in a time where they would need to be crazy popular. And lastly, and this is the last big problem, is foreign nations. They used to buy bonds, they used to love buying bonds, and they're now getting worried that their bonds might not be made valid if there were to be disagreement with the US, as we saw what happened recently in early 2022 when the US made some foreign-held bonds invalid. And so that's a big concern, because foreign nations were major buyer of treasuries, and if the US can make those invalid, so people are not going to be motivated. And this market, by the way, this single issue stock market, is even ignoring some short-term good news, which I don't pay attention to, but there's a few short-term good news right now going on, like oil has been dropping for about 5 days. Oil has been dropping, so that should be good for inflation. Ignoring that, and now it's very clear we're not going to get, it seems very clear we're not going to get a rate hike on November 1st. Market is entirely ignoring that. So the conclusion is short-term red days are opportunities. Even if it's getting old, and it is getting old, and seeing the red creates the same amount of pain in all of us, and we know from prospect theory, one of the hallmarks of investing, we know that it creates more pain to see red than to see the equivalent in the green. Minus $100 create way more pain than plus $100. But it's important to be objective, and in my view, the best way to go is to DCA. And DCA is what most people already do. If you have recurring income from a job, you'll be DCAing. And I guess the more dangerous thing is if you get a lump sum payment. I would put a lump sum payment. I would put in the fortunate problem category. If you have a lump sum payment coming, obviously, in my view, it's better to just invest it over multiple months, if it's a big sum, over multiple years, instead of investing it all at once. But that is just my view. And I'll finish with this. We still get opportunities. I'm not making an Enphase video today, but you bet, at $112, you bet I'm buying some Enphase today. Right? It's important to not ever go all in. You always want to keep dry powder, but you bet I'm buying Enphase all the way down, and then I'll probably be buying it back as it goes back up too. Stock I covered once on the channel, but I'm getting more and more interested in batteries and studying batteries and battery tech more and more. Is a stock like Enovix. Enovix is down 15% today. Seems to be because of they're doing factory upgrades, so it's the same tension, long term versus short term. Companies being long term, so they're getting a downgrade. But if you look at Enovix, that's a stock that from May to early August it doubled, and then it halved again. So what a roller coaster this company is. Quite a roller coaster. But it could. Who knows? But I'm studying slowly this company. I might make another video on Enovix. And lastly, and I guess this is the sad part, it's 30% of my portfolio. It's Tesla, and it just will not go down. Like, it didn't go down yesterday. I was really hoping. And then today we get a big red day. I was really hoping it goes down. It's just not going down. So come on, Tesla. A little drop, please. I'm ready to buy more. I want a drop. But it's not happening. So anyways, that's okay. That's okay. Maybe someday. Thank you so much for watching. This was not investment advice. This is just entertainment. Hope you were entertained. Please like the video. Please subscribe and have a wonderful day. Thanks for watching.